Okay, before we head in to the Q&A this week, for all the applied series candidates, if you once you log in on the left menu, you'll see an applied series Q&A. You can click on this, and it is a live session. It says here 90 minutes, but if there are lots of questions, I'll go longer than 90 minutes. I will do the last Sunday of every month. The last Sunday of this month is March 26th. This is 12 noon to 1:30 p.m. This is Eastern, so New York time or Toronto time. And you can, I use a Vimeo live feed, which has a chat window. You can type in any question you want, and I can answer it. Usually for these types of sessions, I have my black screen up, and then I just draw on my black screen if I need to draw a picture or a chart or a diagram. But it is open. You can ask me any question on any part of the applied series at all. If this is well attended, if there are a lot of people that show up, it highlights to me that, well, now I need two sessions because there's too many people in one session. I'll open up two sessions. If those are crowded, I'll go bi-weekly. If those have a lot of people, you get what I'm saying, right? I'll just keep adding sessions until I see that each session has a manageable number of people. And if nobody shows up after the first couple of Sundays, then I'll say, okay, well, we tried. It's a feature that nobody wants. Let's not do it. But this is our first one, and this is for all the applied series candidates or customers or subscribers, whatever you want to call yourself. The first live Q&A session, March 26th at noon. All right, let's go answer some questions. Let's begin the Q&A from the March 19th Market Outlook. And if you've been on the site the last couple of days, you'll notice that all ads are now gone. I've demonetized the channel for two reasons. Number one, on an after-tax basis, it wasn't anything to talk about. You don't make a lot of money on YouTube with education. You have to have some form of entertainment to get all the big views. Because the truth of the matter is, the vast majority of people will spend hours a day entertaining themselves, but only minutes a day educating themselves. So education channels are never really, the really popular ones. The other reason was in watching my own videos through YouTube, not through the studio, the back end, but through YouTube, so that I actually get to see what ads there are. I've noticed that there are a couple of finance websites that are advertising that are just, I think along the lines of what Raging Bull was convincing you to pay for stuff that isn't worth anything. So being that I can't control who advertises on the channel, I decided that given the after-tax dollars that I was getting, it just wasn't worth it. In exchange for that, what I'm going to do is within each video that I put up, you'll have to put up with a 30 to 45 second blurb every now and then of me promoting my CFA product, because I do teach all three levels of CFA. So I will be letting viewers know that I have that. Fair trade-off, I think. Okay, let's jump right in. First question, second paragraph, advice for current U.S. home buyers. Given fast-changing interest rates, prospect of a recession, not sure if I should wait for a bit to buy a house in order to benefit from the lower rate, or if there will be a recession, will there be fewer supplies of houses and therefore I should buy now? Well, if we look at the data from yesterday, new home sales really popped, a big number. But the other interesting thing in there was the year-over-year median home price, and that is reported every month. And for, I think, 130 months straight, it was always higher. It was the first time it was lower, breaking like almost an 11-year streak of year-over-year, every month, year-over-year median home prices being higher. So it was lower, so there is downward pressure on housing prices right now. And it is down the most in the places that had the most new home construction in the past few years. Interest rates, I do believe that mortgage rates have less upside risk than downside risk. In other words, if mortgage rates go up, I don't think they go up as much and for as long as what mortgage rates would go down by. So if I were thinking about buying a house, I think I would wait out the spring season because that's always the wrong time to buy. It's a seller's market in the spring, or as much of a seller's market as it can be. I would wait till July, August, September, because that usually the selling season is dying down. You've missed the summer, you're going into the fall, traffic starts slowing down. Usually you have sellers that had listed in the spring are now dropping their price if their house is still on the market, and you're inching closer and closer to potential recession, which should really lower rates. If you wait for that to happen, I think that would probably be the better place to be. Let's see. How does the debt to GDP situation get resolved? Shouldn't this come to a head at some point, or can it continue on for a surprisingly long time? It depends. It depends on the level of the real interest rate, not the level of the nominal interest rate. You have to look at the real interest rate. And if you take real GDP growth, and if real GDP growth is higher than the real interest rate, I'll put real, that's real cost of debt. If it's higher than, it would be the weighted average cost of the debt of whatever the real rate is. It can go on for a very long time. Also, you have to look at the percentage that are owed to domestic owners. So if you have, let's say, 95% of your U.S. Treasuries are owned by U.S. citizens, that's not such a big deal because you have taxing authority on your own citizens. And you also have to look at the proportion of your debt that is owed in your own domestic currency. If 100% of your debt is owed in your own domestic currency, you can always print money. So there's a lot of things, a lot of benefits for the U.S. in this respect. This is questionable. However, for a very long time, the real interest rate was negative, and real GDP was positive. So the debt at that point is not really that important because the real value of the debt is decreasing. So it actually improves the ratio. The problem is if you have elevated rates for a very long period of time and you have a tighter credit cycle in the next cycle, such that real GDP growth is held to about, let's say, 1.5 to 2%. But real rates, and we'll take the 10-year, for example, which is a good one to use. If the 10-year is sitting above 2%, is greater than 2%, then you have a problem with the debt. Then there's going to become an issue because the real value of the debt is increasing over time instead of decreasing. Usually you would take periods of inflation to deflate your debt. However, the U.S. Elected officials are totally blowing this opportunity. So we had a crisis where we have high levels of inflation, which means tax revenues are going to increase automatically when you have high levels of inflation because prices go up. So all sales tax revenues increase without raising the rate. And since wages are increasing really fast, everyone's paying more income tax without raising the income tax rate. That should be used to pay down the debt because there are budget surpluses in a lot of states right now. Well, that's not being done. In fact, we're layering on more debt right now than anything else. So we're actually wasting a crisis. Now, that is one way to handle it. The other way is just print your way out of it or construct monetary policy in such a way that your real interest rate is lower than real GDP growth. That way you can pretty much carry it on forever. Could the Fed adding money to the balance sheet lead to a liquidity issue that could cause a breach of the U.S. debt ceiling? Well, these are two separate entities, right? You have the Treasury and you have the Federal Reserve. They have different balance sheets. So no, nothing the Fed does can affect that debt ceiling, at least not in the way that it's described here. Let's see. Downright terrified of the prospect of managing other people's money. That can be a problem, right? Don't think I'll ever feel comfortable making financial and wealth and well-being related decisions for other people. Is there a place in the finance world for me? You could just be an analyst. You could just be a really good analyst. Analysts make a good living, not as much as asset managers do, but they do quite well. And there you're just offering your deep experience within a particular company or particular sector, and other people are making bets on it. The other thing you can do is just be a wealth advisor. And the wealth advisor doesn't set up the asset allocation. So if you're a wealth advisor, it's a relationship role where you bring in clients and you fill out some forms, the get to know you client, the risk tolerance questionnaire, and that gets sent in somewhere, and an asset allocation is derived by people who know how to do that kind of thing, and it's sent back to you, and you take some money in. That money goes into different for different managers who are managing different sleeves of that allocation, and it's somebody else that's managing the money, and you're managing the relationship. So you can go into the pure analyst role or into the relationship role. You don't actually have to manage assets. The other alternative is you could be a asset manager for a passive fund, one that is simply meant to track an index. There doesn't matter what the return is, as long as your tracking error is really low and you're tracking the index. There's still a big call for passive. A passive portfolio still needs an asset manager involved in it, just not as much as active, but still needs that. You could be a trader executing trades. At that point, you're not really too concerned about, if it's going to be the right trade or the wrong trade. You have to sell a block of 10 million shares of something, and you have 2 days to get it done. Well, that's a job. Lots of places for you. As a fellow Canadian hedge fund professional, I think you're uniquely positioned to answer my question. I've heard that Canada-based hedge fund managers have a distinct disadvantage compared to the U.S. counterparts when it comes to accessing alpha-generated information and raising capital. Do you think that's true? No, I don't. Only because we're not restricted to the Canadian market. We have global markets. We can do anything that a U.S. person can do, and a little bit more, because there are some things that we have available that they don't. So we do have no, I wouldn't say we have advantage. We have no disadvantage over a U.S. Firm. The only thing that would have to be dealt with is the U.S. firm would deal with U.S. dollars and have no currency exposure, whereas the Canadian firm, unless you're raising U.S. dollars, if you're raising Canadian dollars and investing in the U.S., now you have a currency conversion issue. So you have to determine the level of hedging and how you're going to hedge. But as far as information, I've had a Bloomberg subscription. You can get any data subscription you want. They're global. They're not specific just to the U.S. So no, I don't think that we have a disadvantage. If it were a Canadian-based Canadian investment hedge fund versus U.S.-based U.S. investment hedge fund, I would say that the opportunities are different. It's not like they're less. The U.S. has a far better derivatives market than Canada does, and any Canadian hedge fund would probably lean more towards natural resources than the U.S., which would lean far more towards tech. It would just be a different flavor, but I don't see a disadvantage if you're willing to have your funds cross a border. Why is reverse repo becoming more important after 2021? Googled, found out that before April, the reverse repo was basically flat. Well, there's just been a lot of cash dumped into the system, and that cash needs to find a home, and there just aren't enough homes for the cash, so that money's got to go somewhere. So it goes to the reverse repo facility. And the Fed's balance sheet is huge, and it has a lot of securities, so those securities don't necessarily have to sit on their balance sheet. Some other institutions might find them useful to have, and that's all that. It's a function of all the cash floating around in the system. I understand how we have to focus on break-even rates to assess if our expectation of inflation is too high or low. How do we interpret real yields on their own? What is the information we can extrapolate from the fact that, for example, the 5-year real yield has decreased from 1.62 to 1.34? Just reflecting the market to price a future rate cut, or is there something else we can say? Well, the real yield usually is a function of, if you have a minimal amount of intentional financial engineering, and we just haven't had that. Since 2009, you've had nothing but financial engineering from monetary authorities on the yield curve. Heavy financial engineering. So that distorts prices, including the real yield. It had been negative for a very long time. But usually the real yield will reflect the growth potential of the economy. So that if you have a higher growth potential growth, your real yield should be higher. If you have lower potential growth, your real yields should be lower, because if the real growth of the economy is 1.2%, that kind of sets out what the growth of your money should be over that period of time in a real basis. Not controlling for inflation, because inflation does its own thing. So it should be fairly consistent in the absence of heavy financial engineering with the rate of real GDP growth, so that the real yield then becomes sort of a market signal about the expectation of real growth. We've lost that. There almost is no meaning in that at this point. So I don't know that when you have a price, and a yield is a price, it's just the price of money. When you have a price that is so distorted and so engineered that it really has no particular meaning in terms of the signal that it provides, but the real yield, when you're cash flow forecasting, it's easier to forecast real cash flows because you don't have to worry about changes in price. You just have to worry about changes in quantity over time. And you discount those real cash flows with a real discount rate. So the real yield sets up the beginning part of that real discount rate. So the lower the real yield, typically the lower the discount rate on those real cash flows, the higher the present value of those cash flows. But beyond being a part of the discount rate, it used to have information about the expectation for real growth. It doesn't have that anymore. Why Lennar and DHI are FRM sensitive? Because they sell houses. And when people buy houses, it is the affordability of the house that's important. So you can't really, we can look at housing prices, but the fulcrum security there is going to be the 10-year yield, because mortgages are based off the 10-year yield. So if we look at where the level of fixed rate mortgages are, the lower the level of fixed rate mortgages, the higher the demand for homes because affordability improves. So for selling the house, the fixed rate mortgage rate is a driver. For agency and Annaly, they own mortgage-backed securities, but they hedge out the interest rate risk component, and they isolate just the spread between the MBS and the 10-year. And then they lever that up. So the value of those companies are more sensitive to the spread between a fixed rate mortgage and a 10-year, or more correctly, the spread between the mortgage-backed security and the 10-year. So that's the difference. They just have different products. One is holding mortgage-backed securities. One is selling houses. Also, I noticed in your first graph, the UST decreased by 31 basis points, not 14. You have to go Thursday over Thursday, not Friday over Friday. The graph is Friday over Friday, but the fixed rate, mortgage rate that we get from Freddie is as of the close of Thursday, not Friday. So you actually have to go Thursday over Thursday on the 10-year yield, not Friday over Friday. Currently CFA Level 2 candidate, writing in May. I'd like to begin an investment fund focusing on stock selection after finishing Level 3. I ask myself what value such an investment fund can potentially provide to clients given the number of both active and passive funds already available. Well, probably not much in that sense. If you're new, attracting assets under management is going to be tough. It's going to be hard to do. But, other than, you're not going to be investing in anything unique that nobody else can invest in. You'll be investing in publicly traded securities. But if you approach it in the sense of having certain rules, we're not going to use any leverage. We're going to buy securities. And we have a very particular process that we go through, whether it be deep value, whether it be growth at a reasonable price, but that you can demonstrate that you have a heightened ability to identify good GARP targets, good value targets, good growth targets, that you are a good stock picker. So you don't have to get fancy. You don't have to say we're using this kind of leverage strategy with this and that, and here's our quantitative strategy that we use, and high speed this and that. You don't have to get fancy. You just have to say we are really good at picking stocks, and that better be true. And if you are really good at picking stocks, well, there you go. So what you would do is you would start now and demonstrate that, and you'd have to publish somewhere. You'd have to actually state what picks you have before the fact, because I can go back through history and say, oh, in 2012 I picked these 5 stocks and they turned out to be winners. In 2013 I picked these 4 and they turned out to be winners. If there is no evidence that I actually picked them before the fact, well, then there's nothing there. So you'd want to run a paper portfolio for a while, because, well, there's your audit trail of when you actually made the trade and what the outcome was. So if you are a better stock picker, if you have a method of analyzing, if you have a model in a particular subsector that makes you better at spotting opportunities than somebody else, or spotting what a winner looks like before somebody else notices what a winner looks like, well, there you go. People are attracted to success. So if you can show that your strategy has success, people will be attracted to you. But, you're asking people to part with money to start a fund. What I would urge you strongly to resist is friends and family, is starting a fund with friends and family, because they'll never let you forget it if you lose money, and you'll never forget it if you lose money, and you'll feel the obligation to return it. Whereas with strangers, you won't feel the obligation. And if you are taking money from strangers, make sure they can afford to lose it. Make sure they are accredited. Make sure they are wealthy, and you'll be okay. Let's see. I've been reducing my oil exposure lately. Okay, that I read this before. That's just a comment. Let's see. General question, Q&A. Why does the Fed have 25 basis point target range? It depends on what the country is doing. Canada has a 50 point target range, right? So they have their target rate, and then they have a rate that's 25 basis point above it called the bank rate, and they have another rate below it that's called the overnight rate, and it's 25 basis points either way. I remember this because of the band BTO. The bank rate, the target rate, and the overnight rate, right? And there's the Bank of Canada taking care of business every day. Some of you may get that. Some of you may say, what the hell is he talking about? BTO, never heard of them. Oh, do yourself a favor. Do not deny yourself the pleasure any longer. Google them. YouTube Music, and then sit back. Let's see. And as far as 25 basis points, that is the range. As far as hiking by 25 or 50 at a time in increments of 25, it wasn't always that way. Sometimes, if you go back to like the 70s, the 80s, this idea of press conferences and signaling, that never happened. You just find out one day that rates were changed by 21 basis points, 19 basis points, 17 basis points, 37 basis points. Just really weird, odd numbers. What are your thoughts on shorting discretionary sector? After all, these would be impacted significantly in a recession. That is true. How would you think about timing? Well, timing is, I don't know that there is a thing called timing. I think you can get lucky sometimes with your timing, but I don't know so much that we can think of timing the market as time in the market, right? Because timing is random. You don't know when something is going to happen. So, for example, weeks ago, I said, even months ago, I said, what we would look for in a short position on a market is some kind of significant bankruptcy or credit crisis somewhere that nobody expected. Well, usually in times of stress, it's going to happen. Where? Nobody knows. So timing that becomes very difficult. So it's a matter of your forecast. You have to have like what's your horizon? If it's a 6-month horizon, that's your timing. Well, that doesn't mean it's going to happen tomorrow. Maybe it would have been better to wait 2 more weeks before you put on your trade, because maybe you went through some pain before it got better, but you don't know. You don't know. Nobody knows the future. All you can do is do what is comfortable for you to do. If you feel you have a particular skill at timing, then you can go ahead and try to time the market. But I've noticed over the years that I am very good at my picks, but I am not good at timing. So I take time out of the equation altogether, and I say, I don't care about time. I'm just going to take my picks, and yeah, I'm probably early to the trade. I'm usually early to every trade, but I've already figured it out. I'm 5-6 moves ahead on the chessboard. The market's playing 1 or 2 moves ahead, so I got to wait for it to catch up. Then it goes, oh my God, checkmate. He was right. So I don't really think too much about timing. You say that taking short positions is tactical. It is. It is, because there is a bias. Just a bias among the market to go to push prices higher, and it is a few people who think about short positions, but the majority of money is long money, pension money, insurance money, bank money, a lot of mutual funds. There's not as much short money in the market as there is long money, so it requires a level of fear for a short position to work out. And if fear subsides, people get back to business. Okay, let's start buying again. When there is fear, well, then money flees. That's the only way that short positions work out, is money flees the market. So you have to be tactical, because fear just doesn't hang around for very long, at least in the American market. I am usually in awe at the American market's ability to ignore almost absolutely everything. And there are times where in the middle of the night I'll wake up, I look at futures down 56 points. I think, oh, well, okay. You get up in the morning and they're up 10 points green and everyone's positive. And you think, well, what happened? And you can look at the data and go, well, that's not good. But for the American market, it just doesn't seem to matter. That was so 5 hours ago. How long do you want us to sell off? We did sell off in the middle of the night. That was 5 hours ago. Let's get on with things. We see it now, right? That as of now, the price in the market is higher than before SVB. It's higher than before SVB. So what the market is saying is that this market now is worth more now that has happened than before it happened. It's worth more now that we've had a number of bank failures, including Credit Suisse. It's worth more now than before it happened. And you wonder, well, what are you thinking? So yeah, being short, you must be tactical, because the American market has a really short memory, and a huge long bias, and probably is, of all markets, the most bullish and the most optimistic all the time. So that's what you're shorting. How do you think about setting DTEs on your negative beta options? It depends. It depends on like, I can't give you a set of rules. It really depends on how I feel, what I'm trying to get done, how much time I think I need. It depends on a lot. Can't seem to remember, but it is something I want to be watching out for. In a video, you mentioned IYR dividend yield, mean reverting levels, and recessionary levels. Okay, so if you go to Koifin, you can look at a chart of IYR. This is the dividend yield of IYR. So you can sort of just eyeball the chart. You can sort of think, well, right here seems to be kind of a mean reverting level. This up here looks kind of like an outlier. This down here, 2008, kind of looks like an outlier. This kind of looks like an outlier as well, a certain number of standard deviations from the mean. But if you kind of try to find the middle with an eyeball here, you get to about 3.8% on the yield. It's sitting at 2.93%. So we would say that it is overpriced based on where it is right now, that as the price falls, the dividend yield rises if there are no dividend cuts. If there are dividend cuts, then the price has to fall even further. But if we're thinking about recessionary levels, I would seem to think that you'd probably be higher up here around 4.5 to the 5% range. This was the last recession this was the post-recession over here where prices were really low. You can see where the dividend yield was, going into 2009, and then during this long period of time, I think things were okay. It was only about the last 2018 onwards where cap rates just started dropping and REITs really took off, and dividend yields, even on most REITs, you'd expect dividend yields to be somewhere between 5 and 7%, were sometimes between 1.5 and 2.5%. Didn't make any sense, but you can just plot the dividend yield of a particular stock and you can look for a mean reverting level on that. Okay, let's get back to where we were here. Caterers and band will be there for you. Fed this. Yeah, we'll pass on that one. If you decide to get a 0.5 delta long exposure, 90-day expiration, do you prefer 1.5 or 2.25s? I'd prefer 1.5. Which option choice would be more profitable? Well, I don't know. It depends on how far the underlying goes. If the underlying doesn't go far enough to put the 0.25s into money, then the 0.5 would have been more profitable. But if it really, really runs, then the 2.25s would have been more profitable. In what scenario would it make sense to choose 2 times 25 over the 0.5? If I staggered them, so if I took a 90-day and 180-day, I might take 0.25 on each of those if I staggered them. I don't know. I can't think off the top of my head in what scenario would it make more sense to take 2 of those versus one of the others. Cost, I guess, if you're trying to get lower cost, but you have to look at how far away is when you think 0.25. What is the likelihood in the 90 days that it's going to make that kind of move? So you'd sort of have to back test that. Sometimes it's easier to look at the options in terms of standard deviations. So 0.25 would correspond to what standard deviation, and then you have to determine whether or not over that period of time, the history of that stock, how many times has it moved that much in that short a time period. Let's see. Videos seem a bit too complicated for me. Want to ask advice? How would you advise me to approach? Should I slowly watch a video sentence by sentence and Google everything, or should I start with some other basic courses? Well, if you head to markmeldrum.com and you can register for free, the entire CFA Level 1 from 2018 is there. If you're not pursuing a CFA charter, you don't need the latest version of the content. 2018 had a solid grasp of the basic fundamentals of the asset classes: equity, fixed income, derivatives, and alternative investments, along with a good introduction to economics, especially monetary and fiscal policy, international trade, currencies, corporate finance, the way companies make decisions about things, so that when we're analyzing a company, we can start to think like management thinks when we look at the balance sheet. So there's a portfolio management, which gives you a nice high-level view of how we can combine risky assets into a portfolio that then have lower risk at the portfolio level than the sum of the individual risks. It's all there, 2018 portfolio management. And now that I've said that, maybe in this video I will stick a little ad in there showing you how to do it. So you just keep watching and I'll put something like that in. But yeah, I would start there if you want to expand your knowledge of finance in general. And you never know. You might really have an affinity for it. You might like it. You might get addicted, and then you might say, you know what? Let me credential myself. Let me signal to the market that I at least know this, because you might want to lean towards a profession there. Well, you need some kind of market signaling device, and a credential usually is the best market signaling device, right? Given the current situation the economy is in, Inflation is still high and no sign that it'll come down, and recession fears. If the Fed doesn't raise rates, won't it mean that we are back at square one? I'm really curious to know what you would do if you were in their place. I'm not sure what your definition of square one means. Well, I think they have a tough job, period. I think they have a tough job to get through. I would seem to think that you could run with this calculus, is you could say, listen, given the events that happened in the banking sector, is credit going to be more available, the same, or less available? And I think at the margins you would have to say, well, it will be less available. I can't see where banks would say, okay, now let's really lean into our lending. I think it would become less available. Well, isn't that equivalent to a tightening? Because you raise rates to tighten credit. That's really what you're trying to do, is tighten credit. Well, if banks are going to self-tighten credit, is that not doing the Fed's job for them? Has the crisis not been equivalent to a 25 or 50 or even 75 basis point move at this point? However, if they do not raise, here's what's going to happen. The equity markets are going to throw a party. And if they throw a party, all the debt equity ratios, because equity will be increasing, all the debt equity ratios will improve, meaning that the debt capacity of the economy will have increased, and make companies more bankable than, or at least more able to finance debt or take on debt than they were before, would actually loosen financial conditions. So it's a tough one. I think they really are at a point where it's damned if they do, damned if they don't. And I'm not sure how the market is going to take it, but I would seem to think that this market, in this last 2 days, its willingness to forget the U.S. banking failures, its willingness to forget the FDIC having to step in, its willingness to forget that the Treasury had to step in, its willingness to accept, to forget that a consortium of banks had to put up $30 billion, and that's still not working. Its willingness to look past Credit Suisse failing and UBC having to take them over. Its willingness to look past that kind of hints to me that no matter what the Fed does at 2 o'clock, this market wants to go higher and wants to trade at 19 to 19 and a half times shrinking earnings. I don't know why. And this is the frustrating part of being short U.S. markets, is the bias to go higher regardless of what's going on. I have noticed in the years that I've been doing this, whenever I do have short positions, is the writing is on the wall, but the market will not respond. You could have smoke on the mountain, and the American market will start to buy houses closer to the mountain. You can have fire at the top of the mountain, and they'll start installing swimming pools and decks and fences. The fire could be coming down the mountain, and they'll sit on their back porch with an expensive bottle of wine watching it, saying, well, somebody will put it out, right? I mean, somebody will put it out. Not until the curtains are on fire do they feel the need to leave the house. And that's pretty much the short story. Is yeah, all the evidence is there, but be prepared for the vast majority of the market to ignore it. Now, you might argue, you might say, but that is not efficient. You are confusing efficiency with correctness. Efficiency, and we'll write the word down here, is how easy it is for information to get into prices. That's all it is. But information doesn't get into prices without interpretation of that information. So it's not really the information is reflected in prices, it's the belief about what the information means that gets reflected into prices. And in the US market, information finds its way into prices very, very fast. In other words, there are no impediments to information getting into prices, but there is no gatekeeper that says, whoa, your interpretation of this information is wrong, hence it's inefficient. Prices are efficient because they reflect new information very, very quickly. However, they are often incorrect. They are often incorrect. So it's not a matter of an efficient market is a correct market price. No, an efficient market has the interpretation, the dollar-weighted interpretation of the information within it. If you have a market that is heavily biased to the long side, that market will be incorrect to the upside many, many times. The prices are incorrect. We even have a word for when prices readjust. It's called a correction, to make it correct, because they are often incorrect prices. So over 4,000 on SPX this morning, is that a correct price? No. Is it an efficient price? Yes, because whatever interpretation people have of information, it has shown up in the price. There's nothing impeding the information to get into the price. That's efficiency. About this $297 billion increase in the balance sheet, can we call it QE? I don't know that it is QE in the sense, because they're not really buying securities to manage a yield curve. So no, I wouldn't call it quantitative easing in that sense. So it's, does it have the same effect? I don't think so, because it's basically, think about it this way. I have a comic book collection that I'm going to give to you, and you're going to lend me money against my comic book collection. Well, there's nothing in the marketplace that is pushing the price of comic books up, because no one's transacting in the market. But if you went into the market to replicate my comic book collection, you would drive the price of those assets up in the market, because you're a buyer in the market. Which would then make me wealthier, because you push the price of my collection up. So me giving you collateral and then you giving me money does not in any way affect the price of that security in the market, which means there is no effect on the yield curve in that sense, so I wouldn't call it QE. Love to know your view on the crypto latest rally. Does it make any sense? Well, crypto doesn't make any sense to me at all. Actually, let me clear that up. Crypto makes all the sense in the world to me. Okay, if you have a blockchain, in other words, if you're using a distributed or decentralized system, well, you're going to need some kind of blockchain. Well, if it's decentralized and distributed, who's motivated to authorize all those transactions? Where is all of the checks and balances going to come from? From individuals. Well, how are you going to get them to pick up the cost of, let's say you have this company over here and they have all the servers, right? Well, this company pays a lot of money for this. But if it's distributed, well, all that money is not being spent, but that money still must be spent by somebody. It is more efficient to do it here. It is inefficient to do it on a distributed system, but somebody has to pay to get it done. Well, who's going to pay who? Well, you got to come up with something, so why not have this little token over here and you get these tokens? If you have a blockchain, you need crypto. So crypto makes all the sense in the world. What doesn't make sense is the existence of a blockchain. It makes no sense at all. In fact, it's counter to entrepreneurship. It's counter to innovation. The idea that you're doing it to protect your data is, I think, to me, the silliest thing in the world. You have already made the agreement with all of these companies for the service that they have. You say to Google search, I tell you what, you give me your product for free and I will give you my search history. How's that? That's the deal you entered into. Google will be happy to say, we won't track any of your search history, and instead we want you to pay 10 cents a search, because that's what it costs. You don't want to pay 10 cents a search. We'll get somebody else to pay the 10 cents a search, but we need to sell this person something to get the 10 cents a search. If you let us track your search history, we'll sell it to them and they'll pay the 10 cents. Once you do this, who's going to pay the 10 cents? Where's the motivation to innovate on search at all? Who owns search? Nobody owns search. So who's going to invest anything in building a better search engine? Who? Nobody. So the idea that you decentralize the very thing that's subsidizing what you're getting for free, all you'll have to do in the end is pay for the very thing you got free. You want Gmail? Well, $9.99 a month. Oh, you don't want to pay for it? Well, then somebody has to pay for it because this stuff costs money. right? So my thought on crypto is, by the transitive property of this being useless, crypto itself is useless. So I'm not a big fan of it. However, people believe in it. And because there's all this issue about banking and credit and money, well, you know, the gold bugs and now the crypto bugs run to their preferred, you know, their preferred hiding place. So that's my take on it. Let's see. I don't know why this thing shows up there. Let's get rid of that little thing. Do you think it's possible that we end up getting some kind of bear steepener on the long end when the Fed does end up cutting? That's exactly what you get on the long end, is a bear steepener. But the bear steepener doesn't mean rates are going up. A bear steepener can happen. Oh, a bear steepener. Hang on. Okay, I forgot the word bears in front of there. A bear steepener. No, I don't think it's possible to get a bear steepener on the long end if rates are going up. You'd get a bull steepener, but not a bear steepener. So, okay, no, I don't think it's possible to get a bear steepener. It would be an odd situation to get a bear steepener. In what the Fed has recently done with the discount window, okay, I already answered that. What's the difference between futures and CFDs? Futures are based on a future price. So let's draw out a timeline, and let's put an underlying asset here. And you have a futures contract here. Right, well, the futures contract is based on the price over here. So it'll include the cost of carry. So what does it cost to borrow money to buy this, to carry to this time and sell this? What is the value of the loan going to be? That is the futures price today. And it expires. A CFD, a contract for differences, does not take the futures price, takes the price of this thing right here and does not expire. And is cash settled. And is over the counter. This is exchange traded. But has an expiration. However, you can use what's called an infinite futures contract, one that doesn't expire, but they come with peculiarities. So if you've never used one, don't bother. It's easier just to keep rolling over. It really is. That's the difference between them. In the U.S., nope, can't. There are no CFDs in the U.S. They're illegal in the U.S. I think it has something to do with the fact that they are OTC traded, and I'm not really sure exactly what it is entirely. Now, some CFDs can have any underlying, by the way. You can have a futures contract as an underlying, and the CFD would use this current futures price, which is the future price of the underlying. It starts to get really confusing. So if you've never used a CFD before, I wouldn't use it. The power of it comes in. Let's say that you wanted to buy, I don't know, 100 shares of a stock that costs $50. Let's say, and there was a CFD on it. Well, if you're buying the shares, it would cost you $5,000. The CFD might only cost you, well, 10% of that at most, maybe might cost you $500. And you basically control the same. You win and lose the same thing you would with the 5,000 shares. And if the underlying is a stock, you would get the dividend on the CFD as well. But since you can't use them in the U.S., don't worry about it. I don't understand how equities were at 37.50 in late December, where things were looking nowhere near as bad. What do you think this is? The U.S. market, as I said, has a heavy bias for long positions and is extremely positive almost all the time. Always thinking about the upside. The other bias that is very strong, it's strong in all markets, but stronger in the U.S. is something called anchoring. So that if we see a price do this, and then pull back to here, we anchor to this. Or the market tends to anchor to this and says, okay, we had a pullback. Well, it thinks, well, it's always going to get back. So it thinks that, well, it's going to, head up. It doesn't anchor here. Short positions will anchor here. Long positions anchor here. And since the market is primarily long, the anchoring happens at the peak, at the high rates, and we think, well, let's just get back to where we were. So we had this run up from the beginning of January to February, and then Powell started speaking, and then down we went. And then we had a banking crisis, and then up we went. I want you to think about that for a minute. So there's this idea that, well, the high point before all of that was 4,150. We're at 4,000, so let's get back to where we were. They anchor at the previous price, and then whenever information comes out, they adjust from the price that they're anchored to, as opposed to saying, well, hang on a second, let me have a new price target altogether based on this new information. The new information doesn't cause a new valuation, it simply causes an adjustment from a previous anchor. So because of this anchoring and adjustment, and because of this long only bias, this optimistic bias that's in markets, especially in U.S. markets all the time, you can't really say, hang on a second here. Today is a worse market than it was 2 months ago, and the price of this 2 months ago was this. Just because 2 months ago it might have been that, yeah, but our optimism was extremely low. Our optimism now is extremely high. That 37.50 was way undervalued based on what happened. So there. If a retail investor has been making a living trading, investing out of his personal account, do you suggest incorporating it? In Canada, that doesn't work. In Canada, all you have is an extra cost of corporate filing because the Canadian government has decided that all you're doing is making money in a corporation when you could be making it personally, and you should be taking it out and paying yourself. One of the stupidest laws they had is that retained earnings in a corporation, if your retained earnings attempt to make any money over a certain amount, you will be taxed at a very punishing rate. It was like almost 75%. So what they were forcing businesses to do is, if you have retained earnings, you better pay it out in dividends, and if you're going to invest it in anything, you invest it in your own personal name, not in your corporate name, because you can't shield that income in a corporation. But if you're publicly traded, you go ahead and do what you want. So private businesses got excessively punished, in the name of liberalism. That's usually what liberalism does. It tends to punish success more than anything else these days. Never used to be that case, but in the last 10 or 15 years, it just seems that any form of success is open target for liberalism to punish. My own views on that, but, Let's see, in one of the previous you mentioned you could essentially set up your own hedge fund or family office, but when I did some Google search, most of the results are relevant for account size of 100 plus million. Well, family office simply means that you're a fund of one. It's just you. You're managing your own fund. And when you do that, you can take a far more holistic view of all of your assets. It's just a matter of, if you are a wealthy family, trying to manage everything that you have can be difficult because typically you have multiple streams of cash flow. You probably have multiple properties, multiple expenses, legacy issues to think about, philanthropy issues to think about, and sometimes it's easier to concentrate that all into a particular office, whether that be a family administrator who takes care of everything for you, takes care of your investments, all of that, because it's basically like running a business. Once you get to a certain size of money, it is truly like running a business. So family office is nothing more than a family hiring a CFO to handle all of their issues, right? I have no intention of hiring anyone and will build more track record before attracting outside capital. If you are going to start any kind of fund at all, the structure that you're going to want is a limited partnership, not a corporation. So stay away from a corporation. Does it make sense to hedge interest rate risk of floating rate mortgage using STIR futures? No. At this point, if you have very low rates, it might make sense to hedge against rates increasing. But I can see taking floating rate mortgages when rates are really low. I can see it. When rates are low and rates are high, floating rate mortgages seem to be attractive because you can look at a floating rate mortgage when rates are low and it's a low rate, but the fixed rate mortgage would be a higher rate because you have an upward sloping curve. When rates are very high, you think, well, a fixed rate mortgage is going to have a higher rate. I could pay a higher floating rate for now and rates will only drop. I think you'd only want to hedge a floating rate mortgage when rates are really low. So no, I don't think it makes sense in hedging high floating rates because there's not much more upside. There's more to the downside. When I say downside, lower rates. Just wondering for your income factories, do you still sell calls on rally like Monday? If I own the underlying, yes. However, for Oxy, I'm not selling any calls on Oxy, only puts, because I don't want to wake up one Monday and find out that Buffett took it out at $80 a share and I sold calls at 70. So I'm not selling calls on that at all. Same with FCX, I'm not going to sell calls, but GM I will sell calls because I think it's troubled at 42. So if I do own shares of the underlying, I am perfectly willing to sell calls on rallies on GM. Let's see. How's ChatGPT going to affect the finance industry and finance jobs? I don't know. That's a good question. Here's the one thing I can tell you. It's going to have an effect. Absolutely. Where is it going to have an effect? I don't know. I don't know enough about it right now, and I don't think that anybody really knows. I think there is a lot of great ideas of what it can do and all the things it'll replace, and it's kind of like the early days of crypto where you thought, well, crypto is going to be the whole new thing. It's going to replace currencies. Everything will be distributed. All these functionalities you could put on the blockchain. They'll have this and that and this. And the reality is it's most of that stuff was just stories. But you need a story in the beginning because you might not have a business case that's very solid. So you need stories about all the potential that it possibly has, right? So my answer to that is I don't know, but I know it'll have an effect. I just don't know where. Let's see, new Fed facility. I think it's not just small banks who have a loss on their books if they mark to market. It's big boys joining the party too. How much of this new facility will increase the Fed's balance sheet? No idea. No idea, but I think if you look at the combination of commercial real estate, and this is on the Fed's website as well, if you look at the combination of commercial real estate and regional banks, most of commercial real estate debt is sitting on the regional banks' balance sheet as a percentage of total debt. Not that most of the real estate debt is there, but as a percentage of the debt that they have. Because if you're looking for commercial industrial loans, usually those are the big banks that are doing that kind of stuff. But for commercial real estate, that tends to be much more localized in markets, right? A lot of commercial real estate. Go into any city and look at all the strip malls and smaller apartment buildings that exist and smaller office complexes that exist that are not owned by the big REITs. Those are all typically financed by the regional banks. So regional banks have huge, as a percentage of their total loans. Percentage of the total loans, CRE is huge there, and we know that CRE is having trouble. And regional banks are probably having more trouble in terms of managing that cash outflow because more and more people are hearing that, well, you shouldn't have your money in regional banks. So it could end up becoming much more significant. I don't know. Just because of that real estate, the overweighting of real estate they have on their books. Core sticky CPI X shelter 3 months annualized is 4%. Has been dropping in line with year-over-year CPI for 8 months. Mechanical issue of the shelter measure holding up. That sticky CPI is up 6.5%. I'm sure the Fed is aware of that, and we can say all day long, but inflation is coming down, but it's this, but it's that, but it's this. It doesn't matter. To determine what the Fed is going to do, you have to listen to what they're saying, not what you're seeing, but what they're saying, because they're seeing the same thing. And before the banking crisis happened, I had posted a transcript to Mary Daly's speech and to a video, Mary Daly's video, and Bullard's speech. And in both of them, they said they see no signs that PCE, not CPI, PCE X housing was dropping. Remember, CPI has a big weighting on shelter. PCE has a significantly lower weighting on shelter, so it has less of an impact. They both said we do not see it dropping. And based on the last PCE report, they were right. There was nothing in that PCE X shelter that showed that it was dropping. And they don't have the benefit of PCE on this one. They're not looking at the CPI X shelter, they're looking at PCE. So we can, I hear lots of people on Bloomberg saying, but inflation is doing this, it's doing that, it's doing this. It's like, you're missing the point. You're not in the room. It doesn't matter what you see. You're not in the room. You have to be a Fed watcher, which means you have to listen to what they think they see. Even if you disagree with them, the decision will be made based on what they think they see, not what you see. You may object to them on the grounds of your evidence, but it doesn't matter. You have to listen to what they're saying, and they're saying they're not seeing anything. Now, add to that overnight UK inflation went up year over year, up over 10% now, went up year over year. They're obviously going to be aware of that, and they're going to sit in that room saying, we don't want to be that. We don't want to be that. What would it hurt to go another 25 basis points? If the banks have tightened, and that tightening is more than the 25 we're doing, our 25 increase is not going to have any effect because banks have tightened more than our 25 anyways. So we could probably walk into a 50 basis point rise, and it would not affect credit any more than the banking than what the banking industry is going to do on their own anyways. So they may argue that, hey, a 25 basis point increase at this point, it's not going to matter because banks have already done it for us. So we may as well just walk in there, have some credibility, and keep the fight going, right? How your ZQ December trade turned out. I had kept building my position as it kept going down. I covered half the position, I think at 10 or 12 basis points. And then it really took off the next couple of days, and then I closed it out only to watch it continue to go higher. However, now I look at December ZQ now, it is lower than when I closed out my other 50%. So I actually, the timing, I don't try to time. It just, the profit was nice. I don't know if I'll play it again. I think if I see ZQ approach 95 again, yeah, I think I would probably play the December ZQ again. I profited but left a ton on the table. Yeah, well, same here. Timing is just not my thing. I'm usually right on my picks, but my timing is questionable. You said you sold 102 TLT puts. Could you tell us about the logic of the entry into the position? What time frame? I think these TLT puts are April. They're just the very next expiration, April. Using any indicators? No, indicators are that all those technical indicators, one big field of horseshit. It's just horseshit. No, I'm not using any indicators. What time do you enter? What does it matter? I think on these ones it was at 10:02 in the morning. I don't know that time really matters. I think what your indicators, what time, all of this, all those technical things mean nothing. They're small, little, tiny details that to me seem like you're getting lost in the details and just missing the bigger picture when you start looking at indicators and let's pick a time, let's do this. It's like, no. What is your thought? What is your idea? Do that. That's it. All that other stuff to me is just a bunch of bullshit for doing this kind of stuff. If you want to get something done, then what is the thesis that it's based upon, and then make your trade. So no, I don't look at indicators in that sense. My logic is that given what has happened so far, I don't think that 5.5% to 6% is in the books at all. I think that probably force, another 25 basis points, maybe one more after that would be about as far as they can push it, given what is going on right now. I think that's probably as far as they can push it. But hey, there's a press conference. It's 11 o'clock now. There's a press conference in 3.5 hours. All that could change. But I seem to think that TLT getting back to 100, I don't see it. That I think that 104, I think on the downside for now is probably going to be the downside on TLT. Why managing theta in the meantime also manage portfolio risk? And could you show us the theoretical reason behind this? In the applied series in options, I do show that in the options. When you get to the income strategies, I do explain why managing your theta also manages your risk, because there is a trade-off between high theta and high gamma. There's a trade-off between those, and you want to manage your risk. If you keep your theta below a certain percentage of your portfolio assets, you by default manage the other risk. Brokerage counterparty risk. Well, yeah, you do have risk when you have money at a brokerage, but I think you are insured, I think for up to $1 million on that. I'm not really sure. But you got to pick a broker that is going to be solid. I use a broker. I use Interactive Brokers, and I use a wealth management firm for another part of my funds. I have a custodian. So the custodian, all the assets are with the custodian, and I pay a fee for that, a certain number of basis points. And all the external managers can trade whatever they want, but they cannot access the assets. They can't take the money out. They can't do anything with it. So I know that it's segregated in that sense. Strategy for rolling up the puts. Yeah, you can get that in the applied options course. I have a video on rolling puts, how to protect yourself if the position is working against you. Yeah, that's part of the video. How do you protect yourself against confirmation bias and avoid confirming your cherished beliefs? Well, it's hard. I mean, because you look at the data and then you come to a conclusion. The typical way that I think about it is when I think about what I want to be, and I also think about what would change my mind. What would be the one or two big events that show up that I would say, okay, that's it. I'm dead on that one. I'm out. And then when they show up, you're out. Right? But if you don't know what the risk factors are, if you say, oh, Facebook is going to go up, it's got a lot of upgrades, I'm going to buy Facebook. Well, what would be the risk factor? You'd have to know what risk factor would have to show up that you would then change your mind. What would have to happen for you to change your mind? And if you know that up front, as soon as it happens, change your mind. Let's see. Opinion on Twitter. China authorities caused a run on the bank. I'm not going to comment on that. Would you consider too early to position for small cap or tech? Yeah, if I think there's a recession coming, yeah, I think that's too early. The first would be a play post-recession, yeah. The second, discounts cash flows at low, okay. Also, how do agency compare versus the home builder thesis? Well, two different products, right? Home builders sell homes. Agency leverages the spread between mortgage-backed securities and 10-year treasury. So two different products. Some of you watching may recall, and maybe some of the new ones to my channel may not know this, but I used to have the entire Level 1 CFA series on YouTube from 2017. But I've removed it, and it's still available for free. If you go to markmeldrum.com, you see this thing that says free content. Click on that. You just have to fill out a little bit of information, I think 3 or 4 fields, and you get access to the complete Level 1 from 2018, not 2017. So it's a year updated. It's 2018. If you're not going to be preparing for the CFA charter, if this is not something you want to do, but you want more knowledge about accounting, let's say financial statement analysis, you want more knowledge about economics, and the asset classes, equities, fixed incomes, how we price fixed incomes, what are the risk and return characteristics of that, derivatives, alternative investments. You can get all that with the level 1 content, and it is free. Also, while you're on the site, let me show you something neat. We'll flip over to another screen where I'm logged in. If you look down the left menu, and if you are signing up for free content, you'll get this as well. Go to Jelly Beans. Click on Jelly Beans, and there's documentaries. Click on documentaries. And what we've done, or what I've done, is every time I come across something really interesting related to finance or economics on YouTube, I put it in here. So if you scroll down, it is a nice sort of collection of a lot of interesting documentaries related to finance and economics that you can find right in one place. And yeah, we got a lot of them. Look at that. They just keep going, right? So that's there for free, and you get the entire 2018 Level 1 content for free if you want to continue your education sort of on par with what a Level 1 candidate would be going through for the CFA program, but you have no intention of actually doing the CFA curriculum in its entirety. It's a great way to get an introduction to the content. Okay, back to the Q&A. In the change of CA curriculum video, you talked about regression and log. I tried to regress some stock with variables like FFR, GDP, retail sales. I took my value from capital IQ and percent. When I use percent, I'm champion predictor with adjusted R-squared of 90 to 98. I don't know that having a high R-squared makes you a champion predictor. It just could mean that you're overfitting your model to the data, and when you actually go to predict, it may have very bad out-of-sample prediction, which means you have a biased predictor. It's, you know, you can always get 100% fit on data. It's out-of-sample that matters. So the R-squared, I know when people start in a regression, they look at their R-squared and they think, wow, I've explained everything. Yeah, but you know, it's the predictability that's important. So whatever data sample you have, cut it in half, build your model on the first half, and then see if you actually can predict very well on the second half of the data. So I don't know that it would make you a champion predictor just because you have a high R-squared or high adjusted R-squared. When I use log return, I'm as good as the Maple Leafs in the playoffs, adjusted R-squared close to 0, sometimes even negative. Can you do a quick example of how you do a regression? Quick example? No, you can't do quick examples of regression. 95% of regression is pre-work. Running a regression is easy. Most people, when they do a regression, when they first get to it, they want to run the model. Run the model. What have I found? You know, this is going to help me predict things. Well, not if you have a whole bunch of errors on the way in. I can see a bunch of errors right now. You're using GDP and retail sales from Capital IQ. What numbers are you using for retail sales and GDP? Are you using the numbers as they were originally reported on that date, or are you using the revised numbers? For example, you take the stock price as of December 31st, 2019, and you may have a GDP number, fourth quarter GDP number that you're using for December 31st. But that final number wasn't known until March 31st, 2020. So you have something called look-ahead bias. The stock price could not have possibly reflected that information. Second, are you using all of these variables as of the same date? You got a stock price every day, you got retail sales once a month, and you got GDP every quarter. How you figuring that out? How you aligning those things together? And if you're using them on the same date, then I think you got a bit of a problem, because usually the stock price would respond over a period of time to retail sales, to GDP. What you need to use, especially if you're using macroeconomic data, is the difference between the expected and the reported number, because the stock price will price in the expectation. So if retail sales has any predictability, it's not the level of retail sales, it's the gap between the number that is reported for retail sales and the expectation, because the stock price would have already have priced in the expectation for what retail sales would have been. Then what lags are you using? Are you using a 1 week lag, a 1 month lag, a 2 month lag? Can you predict the stock price 7 days out, 9 days out, 12 days out, 15 days out? Where is your best predictor? At what lag? I can see so many issues with this other than just a regression, and I have nowhere near enough information for me to begin to even critique your regression. But I will say this, whenever you're building a model and you have 20 hours in the model, 19 hours and 45 minutes will be pre-work. Running the model's 15 minutes. You run it, you look at the output, you analyze it. The other thing that I'd be curious about is your GDP, your retail sales. Probably highly correlated variables giving you a nice R-squared, but probably insignificant coefficients, which means you have multicollinearity problems as well. Without even seeing your output, I can just run through a whole bunch of issues that I'm seeing now. What are your thoughts on CS acquisition, the complete write down of 17 billions in AT1 bonds? From my understanding, in the prospectus for the AT1 bonds, they ranked below equity. So they did not rank above. They were particular and they did rank below. Okay, let's see. Number one, would you know how the trading business and oil and gas companies help to reduce the price, risk, and volatility? Would you know how the trading business and oil and gas companies help reduce the price, risk, and volatility when price drops, and also taking advantage of price increase? I have no idea what you're asking. My guess is that they would have a price target and hedge out by selling futures contracts on their productions at their target price. Selling forward your productive capacity isn't as big a thing as we would think it would be. Some of it gets done, but it's not a big thing. So I'm going to pass on question one because I just don't understand the wording of it very well. For pension funds or endowment funds, would their sponsors be able to close the fund so that they could use the cash to support their operations during recession? No. In the market, when duration is very attractive, would you buy cheap puts to increase your margin room and sell more put? No. Buffett is talking with Biden's team. My guess is a potential assistant from Buffett, just like, oh wait, what's your thought on that? I don't know. I don't know if he's just a consultant and giving his advice, or if he's interested in buying something. If he was interested in buying something, I don't think he'd be talking to the White House. SVB should have hedged the interest rate risk much earlier. Well, they did have a hedge on, but it was taken off. And I think maybe they were making sort of speculating that rates had peaked at that point. And you can only hedge the available for sale portfolio. What I want to know is, since almost every financial institution will try to hedge the risk of rates increasing, since increases were pretty obvious, wouldn't there be less hedging counterparties? No. The dealer is the counterparty to all of these. Well, I shouldn't say they're the counterparty to all of these. I think they're cleared now. There's central clearing for swaps, but a dealer originally sets them up. And there are multiple parties on multiple sides for whatever reason. Your asset is somebody else's liability. Well, you're going to be on opposites. If you're going to both hedge interest rate risk, you're going to be on opposite sides of the contract. You would be natural counterparties to each other if you're hedging interest rate risk, right? If you have a debt, you don't want to pay more. If you want an asset, you want to receive more. So it's, you got hedging on both sides. So the net position of all those swaps isn't the total of all the swaps. In case you do your Q&A before Jay Powell's brilliant speech. Brilliant. It's Tuesday morning and ES is popped with tech moving north again like last week. It's looking like equity markets may actually believe the whole banking crisis has been extinguished. Yeah? Do you think there's a case to be made for 50 basis points? Yeah, you could make as I said earlier, you could make a case for 50 because the tightening that banks will do on their own would probably be equivalent to 50, which means even if you have a 25 basis point rate hike now, it's not going to change anything that banks haven't already done. So you could probably just walk into a 50 and it wouldn't tighten credit anything more than what the banks are probably already doing on their own. So 25 to me seems like, well, why wouldn't you walk 25? You won't be touching the other side of the room even if you walk 25. So you wouldn't be pushing on any walls at that point. Okay, or do you think they're somewhat bound by expectations? Yeah, I do think that they probably will hold very close to expectations because that's part of their credibility, right? Also, given the likelihood in large negative returns debated, do you believe there's prudence in waiting for security prices to drop before going after those? It being long those underlyings make being short beta a little more palatable. And since it's difficult to time when an entry to something is going to happen, or even if the beta trade will work out, I prefer to have some long positions as opposed to being 100% short. Have some long positions that I'd be interested in holding for the next 3 or 4 years, anyways. So that's what that is. So for me, nah, I'm good. I'm good going in. Yeah, it'll pull back in price, but then that's when I'll add more. Why do you prefer selling 30 to 45 day to expiration options over 10 to 15 days? Well, a lot more risk in 10 to 15 days. Unless you're selling out of them, unless you're selling like 15 delta, then the return per dollar of margin that you need is just too low. Yeah, theta decay is faster, but that's not really what you're trying to get done, right? You have to manage risk along with income. If you reach for income, if you reach for return, you'll probably end up losing quite a bit. If you manage risk, you're going to make money. If you manage risk. But if you reach for return, it's not going to work out because when risk shows up, it's going to hurt you very badly. Manage your risk, return will show up. That's sort of the rule that I look at. Manage your risk. Always manage risk. This is not a market of return. This is a market of risk. And if you manage risk appropriately, taking on just the risk that you want, adding more risk when things look good, decreasing your risk when things look bad, return will show up on its own. A link to the bond ratings data source. That is on Koifin. ABR's upgrade. I'm curious to know what the best sources of service to track upgrades or downgrades to a specific stock. There's lots of sources on the internet that do this. Interactive Brokers has a daily list for upgrades and downgrades under. I can't remember where to click on it. It's a dashboard that opens up. It just automatically opens up, and I see the upgrades and downgrades. I don't really pay too much attention to them because whatever holdings I have in my account, I get automatic notifications from IB whether there was an upgrade or a downgrade to it. I bought the AS the very next day you launched it. Given AS under CFA package does not have an expiration date, will the same apply for early bird subscribers? Any AS subscriber, the same thing applies to all AS subscribers. I booked my level 1 for August 23. I'm going to pass on the CFA questions because I do have a live Q&A session coming up Sunday night on the 26th. So I'll let you ask it there. iPhone rule ASC establishes you basically cannot hedge HTM fixed income assets interest rate risk. That's true. Only the currency risk and credit risk of MBS. Banks can hedge only MBS, mortgage-backed securities. Mortgage-backed securities, I think you mean if banks are holding MBS, can hedge only the embedded optionality related to prepayment risk. Oh, if MBS, they can hedge that. Okay. Given all of this, it seems to me that once the ball of the rise in IR started rolling, management would have had to reclassify all those assets and hedge them from that point. That's tricky to do, right? Moving things out of held to maturity and reclassifying them calls into question why you're using HTM to begin with, and you might run the risk of not being able to use HTM for a number of years. Under the rules. So your auditor would catch that. So once you put something into HTM, you're pretty much leaving it there, right? Taking it out is, you might be able to get away with it once, but if you're doing it a number of times, if it's a repetitive thing that you're doing, that calls into question the whole HTM category that you're using, you probably wouldn't get to use it. Your opinion regarding tax advantaged accounts. Limited in the tools available to produce returns above a market return. That is true. Sake of this question, assume 20K is a substantial amount of what you could save in a year. Do you think it's worth it to max them out? I think it's worth it if you are in the highest tax bracket. If you're in a low tax bracket, don't worry about your tax advantaged accounts. It doesn't seem to me to make a lot of sense at 25 to be putting money into your RSP when you have a 33% tax rate, only to take it out at 65 when you have a 53% tax rate. It doesn't seem to make a lot of sense. Wait till you start making big dollars, and then you will have a whole bunch of unused capacity in your registered account. So if you don't, let's say that you get, I think 18% of your income per year you can put into your registered account. If you don't use it for 20 years, you have this huge unused amount that you can use. You can shelter income for a couple of years at high tax brackets, or bring your income down to lower tax brackets just because of all the unused capacity you have. Wait until liberals give you a punishing tax rate because you're so successful that you really need to learn a lesson now and be punished for your success. Wait until then, and then start using the sheltering capability of it. Past videos, you talked about how you only expect a recession if born from some kind of exogenous event, not endogenous. Are all these back woes something that could kickstart a recession? Yeah, that is endogenous. And this is something, if you want to read a good book on this, it's called Stabilizing an Unstable Economy. It's from the 80s by somebody named Hyman Minsky. You might hear a lot of his name being mentioned in terms of a Minsky moment, which he never coined the term Minsky moment. But he talked about credit and finance, particularly the different stages of finance, from, I think, non-speculative, speculative, and Ponzi. But he didn't call it non-speculative. He called it hedged finance, speculative finance, and then Ponzi finance. And it's unfortunate he used the word Ponzi, because had he not used that, I think he would have gotten a lot more credibility for his theory. But it was just the word that he happened to use. So, but it wasn't intentionally Ponzi. It was Ponzi-ish, the type of financing. But that's a good book to read. And that is truly a story of endogenously led crises. Why do we compare earnings yields to T-bills? Well, you compare them because one of them has no distribution around the return. The other has huge distribution. That's uncertainty. So you have to say, how much more am I getting in yield for uncertainty in the middle of the distribution? That's all that is. Brokers' clients' assets are supposed to be segregated, but what happens if they are not? That's called FTX. Or what happens if custodian goes bust? Doubtful. It would not necessarily be a simple case of moving client segregated assets to another provider, as there may be costs involved. Investors may have to take a haircut. Is it, well, not investors, but depositors. Is it best practice, therefore, to have multiple brokerage accounts if we have large portfolios? Not really. If you're very concerned, gravitate to the bigger and bigger players. I've still not seen anyone who can thoroughly analyze and provide a logical answer. You have to go with where there has been a good long history of good performance. Any of the very big banks are a safe place to be. I've never had an issue with Interactive Brokers. I think I've been with them all through the credit crisis, through COVID, through this going on now. I've not heard boo about any of that. So it would be extremely helpful to hear your interpretation. Already did that. Do you think going long mortgage originators such as Rocket would be a fair play on long duration and lower rates? I don't know enough about Rocket. Are they just originators, originate and sell, or do they have servicing rights? If they have servicing rights and they have a fairly large servicing portfolio, well, maybe, yeah. I don't know enough about Rocket to really know. I think they have much more price volatility than ABR does, though. While doing valuation, how do you estimate market size? GDP report does break it down by... you can get GDP by industry. And then from there you can look at let's say the top 5 publicly traded, look at their revenues, their last year's revenues, and look at GDP by industry, and those top 5 will give you some idea of the market share they have in that particular industry, and then you can go from there. I just read a researcher at an investment firm saying it's stunning and hard to understand how they can reverse hierarchy between bonds and shareholders. Well, again, it was something in the prospectus that those bonds ranked below equity, based on what I've heard. And I think this was from, was it BlackRock? I'm not sure who I heard it from. Any plans to do analysis of one of 5 Canadian banks? No plans, but maybe. How do you manage your exposure to iron ore prices by holding BHP and Rio? I don't. I just have exposure to it. That's how I manage my exposure. Is I just have exposure. So I don't manage. I don't manage my exposure. I don't think it would make sense, to buy a copper producer, let's say, and then hedge out copper prices. It just does. I want exposure to the metals and the minerals. So just because I buy doesn't mean the price is going to go up. This could happen. It's like, okay, well, that's part of the risk that I take on. If the Fed funds range of 4.5, 4.75 is the rate the Fed borrows and lends money at, how's the 4.58 rate is determined? Well, that means the Fed is not stepping in. So what the Fed is saying is, listen, don't pay more than 4.75% for money. We'll do it for you. Don't accept less than 4.5% on your deposits. We'll do it for you. So the rest of the market says, well, if I'm at 4.76 or 4.49, I'm not going to do any business. So I'll go somewhere in the middle. And there it is. It's a market determined. The effective federal funds rate is the rate that the market is going to transact at. Hence, the Fed does not need to step in at those particular rates because it's all at that point more market determined. The 4.5 and the 4.75 are basically how the Fed sets that target rate is with open market operations, right? And the open market operations are conducted by the New York Fed, and they are done within this range. So you must be within this range. If it's outside of this range, well then, no bank would get to do any business at that rate. So it's a simple way of explaining it, but it's basically sort of like words on the tip of my tongue. It's a common word every day to explain when you're in between two things, and I don't have it. But anyways, there it is. Looking at break-even rates. What am I looking at? The actual numbers that tell me inflation expectations are spread. It tells you where you're indifferent. It says you look at a 5-year break-even at 2.4, and if you say, over the next 5 years, I think inflation is going to average more than 2.4%, then buy tips. If you think that inflation is going to average less than 2.4%, then you buy nominal bonds. It is just a break-even rate. Where do you get the equilibrium expected return PE from? History. You just get it from history. Whatever your look-back period happens to be, it is the expected return is the total return on a geometric return basis, and the average P and the PE is the average PE over that period of time, the average forward PE. Let's see. What is your feeling on breaking through the October lows? If markets are truly forward-looking, at some point they will see earnings estimate 24, 25. I sort of seem to think that you're somewhere between, we'll end up somewhere between 16 and 17, and somewhere probably between 200 and 210 on earnings. And you have to cross them like this because one will bottom before the other. So the forward multiple tends to bottom and move up before earnings tend to bottom and move up. So you kind of have to stagger them like that. So 17 times 200 is 3,400. 16 times 210 is 3,360. So 3,400 to 3,360, I think would be probably something that I would look at as a price target. I think it'd be much below that. Would have to be significant. Things would have to be significantly bad. but there's a nice range. So do you think 3,000 to 3,200 is realistically in play? Not at this point. I think earnings have to come down. Cost of capital is higher. The availability of credit is lower. And that means that economic growth will be lower. So all those cash flows have to come down. The forecast for whatever cash flows are going to have to come down for a lower real GDP growth world that we're going into. It's going to have to come down. They're currently at 219. So I'm not really asking much for it to get to 210, right? Or even to get to 200 in a recessionary scenario. And I'm really not putting these down at 14 to 15. These are realistic enough that I think that, yeah, from where we're standing right now, those are more than in the realm of possibility, which would put us 3360 to 3400. Just a little below the lows. Chanos correctly points out historically bear markets haven't ended until they hit between 9 to 14 times previous peak earnings. Well, that's true. Historically, are we in those historical periods now? I don't know. Let's see. Can you explain why the New York effective federal funds rate is not equal to the 1-year U.S. rate? Well, that's a 1-year rate. The EFFR is an overnight rate, so it would not be equal. The 1-year rate has the anticipation in it of what the effective federal funds rate will be every day for the next year. I want to see Meldrum on Bloomberg TV. They would never have me on because they have a CFA product, and I am a CFA provider. They would be having their own competitor on their show, so they would not give me a voice on Bloomberg simply because they would have to introduce me as something, and that's what I am. That's my title because I'm not with any affiliated company. They would have to introduce me as that, and I doubt that they would want to do that. If you are selling puts on ABR and agency, are you holding these in your or your RSP? I have agency in and ABR both in my RSP. I have them both, and I'm selling puts on the outside. What the advantage of having U.S. REITs? No advantage really, but that does not mean that I have to hold them. So let's say I sell a put on 1250. I sell a put on ABR. And let's say 100 shares gets put to me, and my average price when it gets put to me by the time I get it is $11. I can then sell that for $11, and I can create a synthetic on that. Or I can sell this for $11 in my taxable account and immediately buy it for $11 in my RSP, thereby granting my RSP the ability to wait, the ability to have patience and wait for the lower price. I can do that, and if I have extra cash that's built up in my RSP, I can just simply sell it in my taxable account, create a loss. So now I have a loss, which is a tax benefit, and buy it in my RSP account, which would be the same economic effect as if my RSP account were allowed to sell puts. Did you get that? So I don't have to hold them after. I can do all sorts of things with them. CPI is about to drop hard. Okay, all of this is just a comment, so we'll pass on that. Powell should claim some responsibility for SVB. These bank management teams were told the ocean storm would temporarily signaling to banks, go ahead and assume inflation and transit. Well, without any more information, you could say that, but I've had the luxury of being able to speak to someone who, I'm not going to tell you who it is or when we had the conversation or what role they played, but they know a lot more because of where they happened to be at the time, and it was mismanagement because even internally everyone knew what was going to happen, and everyone was saying, or there was a consensus that this needed to be done, but that the CFO said nope. So it people saw it. People warned, alarm bells were ringing, red lights were flashing, but one person decided no. So I don't know that we can place all the blame or even any of the blame on Powell. He's doing what he had to do. Simple as that. It would be like saying, I'm standing in the middle of a freeway and a truck just rolls me over. Do we give any blame to the truck driver. I shouldn't have been standing in the middle of the road. I mean, you could say, well, the truck driver should have slowed down, should have avoided you, should have hit you. The truck driver has to accept some blame. The truck driver didn't expect the person to be standing in the middle of the freeway, though. Now, if there was a sign on the overpass saying, warning, person in the middle of the road up ahead, then yeah, the truck driver would be aware and would then engage in some risk management techniques, right? So let's say that sign was flashing. Well, that's Powell on the sign saying, warning, pedestrian in the middle of the freeway up ahead. Well, all the banks, which are the trucks, should have said, well, let's slow down, let's keep our eyes open, let's try to avoid this. I don't know if that analogy works out quite well, but on this particular case, I think a lot of it lies on the shoulders of management. Difference between 97% implied volatility versus the implied volatility 21% in green. Well, this is saying that this 21% is higher. This implied volatility at 21% is higher than 97% of all the observations in the last 13 weeks, whether it be 13-week, 26, or 52-week IVP. This is the percentile. So the 21% is higher than 97% of all the other observations in the last 13 weeks. That's what that means. I'm a little confused as I state to understand that put selling is attractive. I gave you a video that should answer the rest of these questions. Regarding applied series, I'm not sure if you'll be progressing through the CFA course at this time. May I still purchase AS? Yes, you can. Yes, you can. I understand you like Bloomberg Morning Show and IBKR Portfolio News. Do you have other subscriptions to Wall Street Journal, The Economist, Barron's, Globe and Mail? Not really. Not really. What does your process look like when it comes to all the financial news available, and what are you looking for when browsing the news? A lot of the news that I get is directly from sources, whether it be from the Fed's website, whether it be from SIBO, whether it be from wherever it happens to be. But SIFMA sends me morning updates every morning. I have some candidates that have used me for level 1, 2, 3 that are in well-placed positions that send me reports. From time to time. Some send me it on a regular basis where I'm just on their mailing list, and I thank them greatly for that. So I get it from a number of different sources. I don't know that there's any one single source I get it from, but if I'd rather listen to the Fed speak, the Fed speaker that's speaking, rather than read an article about what the author of the article said the Fed speaker said, if you know what I mean. If I'm following a particular company, you go to investor relations, you put your email in, and you will get notifications the moment it hits the site. I get it in my email the moment it hits their site. So I create my own news stream in my own inbox by doing that. You can go to, almost any any site that has economic data, and you could put your email in, and the notification gets sent to your email box. I still get the grains report every Wednesday, and I don't trade grains anymore, but I still get them, and I if I ever want to read them, they're there, but I still get them. So you can create your own news feed by just subscribing to all the sites, and whenever anything new pops up, you automatically get an email. I struggle to find information and give me a trading edge. It's not information that will give you a trading edge. It is your ability to put that piece of the puzzle into the greater picture, so that when you're reading something is, well, what is the implication of this? What does this mean? It's not the information itself. It's your experience and your interpretation with a particular security, with a particular company, in a particular sector that allows you to see a little bit more. You can, this is a big field of study in entrepreneurship, is where does opportunity come from? And we could say the same thing for trading in the market, is how do you spot opportunity? For example, if you see an empty lot, one person may see a parking lot, one person may see a location for an office tower. Another person may see something else, and it all comes with the history of their experience, how they identify that opportunity. Well, if you have no history of experience with someone, you cannot possibly see the opportunity there. So we see opportunity through our own eyes, and our eyes are the sum total of the history that we've lived and what we've learned. I think Pasteur's dictum applies here more than anything. Chance favors the prepared mind. So what are you prepared for? And there is opportunity everywhere, but you're blind to it unless you have some kind of knowledge of a domain. So if I said, what is the next big thing in education? Somebody who is in the education space would be able to tell you what that would most likely be, more than somebody who is not in the education space, right? So pick a sector and dive deep and be prepared to spend years in that sector. And watch the opportunity that you start to recognize. Opportunity doesn't come your way. You have to basically open up all the windows and the doors to be able to see the opportunity that's around you. Right now, there's tons of opportunity around you, but you're blind. You're blind by what you do not know. So how do you lift the veil? You learn, you read, you expand. Everything matters. But spending 6 hours on Netflix, I guarantee you, will not highlight to you a single opportunity out there in the market. Let's see. I feel I could read news for 5 hours a day and still feel left out of certain topics. Pick one. Pick a sector. Pick a sector and dive deep. Could you explain how to buy short-term treasuries on IB? Yeah, you just, I think I did reply to that. You just go, there's on the main panel where all the icons are, there's a little arrow that, where you can add more icons. Look for treasuries, add that, and it's pretty self-explanatory after that. AT1 bonds, already explained that. The vast majority of the increase. This was a good point on Tyler's point here. Only 12 billion was of the new facility. The rest was just banks pledging their security at whatever the fair value of the security was instead of using par. So that was a good point. If we want to go long the yen against, okay, already answered that. The first pair is the direction that you're trading. So if you think that the whatever value you have you think is going higher, you're long the US. The second of the pair is the currency in which you get paid in. Okay, this is just a comment as well. Canadian banks are safe for one reason. Oh, Maple City. Yeah, you're letting the cat out of the bag there. Reply to this one. Not a big fan of Tesla. If I'm not mistaken, your own price target is below $40. Or below the price by 40. Any reason why I take exposure to name now, or is it just a function of higher premiums? Higher premiums, and it's under momentum. And it's not going to break until there's fundamental news that things aren't going to turn around for it. Or that competition is going to hurt it. So right now, you don't short something under momentum. You can play in behind momentum, but I certainly wouldn't play with higher deltas. I wouldn't be using a 50 delta on this one. It's a very low delta, and it seemed like easy money to make. Let's see. Do you have time to explain why Stellantis is part of the next cycle? Stellantis is the old Fiat Chrysler. It says, why wouldn't they buy current dominant brands? Well, Stellantis is Chrysler. Yeah, so, and they are huge in Europe, and they are the largest EV seller in Europe, bigger than Tesla. And their last earnings were fantastic, absolutely fantastic. They have operating margins just below Tesla's. Tesla is still higher, but of all the car companies, Stellantis is just right below them. What makes U.S. banking industry less resilient than Canada and many other countries? Too many banks. Just too many banks. So you have some big banks and a whole bunch of small banks. Well, Canada has big banks. Period. We just have big banks. That's it. So there's really no place to run to. TD's. If you think that TD's having trouble, where are you going to run to? There's only 5 others. Well, 4 others in CIBC. We got 5 serious banks in CIBC. What would cause real rates to rise? Nominal rates staying the same and inflation expectations dropping. Real rates are just a reflection of an inflation or the inflation expectational adjustment of a nominal rate. What is your source for watching MBS spreads? Well, I don't have one. But I can proxy it by looking at the 30-year mortgage versus the 10-year rate spread, and the MBS spread should be should follow in line or should move kind of consistently with that spread. When stocks go up, recession is looming. Don't know about that. I did reply to that. I replied to this. Replies down here. Is the Fed weaponizing monetary policy to slow down countries like India and China? Oh, I'm not going to answer that. Let's see. Why did the U.S. not formally enter recession in Q1 and Q2? Real GDP growth turned negative. That's not the measure of a recession. It's a broad-based decline in economic activity. And sometimes we can get that from a reading of GDP, but the readings of GDP for those 2 quarters had smaller components within them that were highly volatile, which caused it to be negative. That if you looked at GDI, which is gross domestic income, it was positive. So that if you weighted gross domestic product and gross domestic income by 0.5, because there is an identity that GDI equals GDP, then you did not have negative GDP or negative output during those 2 quarters. In terms of managing margin, and say if we want any net short, what is the maximum percentage DDB exposure you would have? Not asking dollars. Risk Navigator shows as a percent. Yeah, right now I'm negative 28%. However, keep in mind that does not consider if I have bond exposure, if I have Treasury futures exposure, if I have copper or oil or gas exposure. It doesn't consider that at all. It's only the beta portion of it, but I'm negative 28%. I tried to look up Mexican-U.S. pair. IBKR would not pull it up. Yeah, so IBKR has its pairs and that's it. So it may not want to invert the pairs for you. So the only pair is the U.S.-Mexican pair. You are going to be paid in pesos, and that is it. What I'm not seeing here, somebody had left a comment about a trade that they had made. I had said, you could look at, being long 2RB and being short 3CL. The reason you would do that is this is gasoline, this is oil, and these are as close to dollar neutral as you can get. And they had mentioned that they were down 18,000 on it, but from the time I posted the video, I can't see how you could possibly be down. So I checked the price this morning. If you were short 3CL, I used the average price on Monday, which was 80.50, and CL now is 69.33. Which gives you a gain of 33,510 on the short 3CL. For RB, you would have went from 279.62 to 2.5511, which would have given you a loss of 20,588 for a gain of $13,000 on this pairs trade. And this pairs trade is based on the fact that gasoline is going to hold up both to the upside and downside better than oil will. And to get the same dollar amount, you're long 2 and short 3. That trade since March 6th, where are we now? We're March 22nd. In 16 days, that trade is up 13,000. So I'm not sure how you're down 18,000 on that one. So if you are listening and that was your question, you have to wait till the end. I'm not getting the numbers that you're getting. And that's it.